Welcome to this explainer. We're diving straight into something that is absolutely crucial right now, beating inflation. I'm so thrilled you're here because we're going to fundamentally shift how you think about saving, spending, and honestly, just building wealth in Pakistan. You know, if you've ever looked at your wallet and felt like your hard-earned money just isn't going nearly as far as it used to, or if you've been wanting to finally take control of your financial future but kind of felt lost on where to start, well, you're in exactly the right place. Okay, let's just jump right in and unlock how to actually beat inflation. So, I want to kick things off with a direct challenge to you. Imagine I just handed you a crisp 10,000 rupee note right now. But there's a catch. One single condition. You have to keep it absolutely 100% safe for the next 10 years. What's your move? Well, most of us would probably do one of three things, right? You might lock it up in a secure cupboard, or maybe deposit it into a standard everyday savings account, or, just go completely old school and hide it under a mattress. And doing that, it feels responsible. It feels mature, like you're protecting what's yours. But actually, there is a very silent, highly uncomfortable truth about this instinct that we urgently need to talk about. And that uncomfortable truth, it's the silent wealth killer we all know as inflation. And man, it can literally cost you up to 50% of your wealth. In Pakistan, our average inflation rate historically hovers somewhere between 8 to 12% a year. But look, we've all lived through these recent years where it tragically spiked right past 25%. So let's just do the math on that. If inflation averages just 10%, that 10,000 rupee note you so carefully hid under your mattress is going to lose half of its purchasing power in roughly 7 years. Half. In a decade, it's worth even less. You didn't spend a single rupee, and yet you became substantially poorer. Crazy, right? Which brings us to a really hard truth, and honestly, the core paradigm shift of today's explainer. By doing absolutely nothing to risk your money, you are actually guaranteeing a loss. Seriously, your financial future is slowly shrinking while you sleep. The rule here is incredibly simple. Savings protect your money from being spent, right? But investing protects your money from becoming worthless. This is the fundamental, life-changing lesson that traditional schools unfortunately just never taught us. Playing it completely safe is actually the riskiest thing you can do. And, the scale of this problem is just massive. Out of a vibrant population of 250 million people in Pakistan, only about 400,000 actually invest in the stock market. That is less than 0.5%. To put that into perspective, if you look at developed financial markets, that number usually sits somewhere between 40 to 60%. The issue here isn't that Pakistanis don't have money. The issue is that we simply aren't taught how to make it grow. We're literally just letting our potential sit idle. Now, before you start investing, you need to know the vehicles available to you, what the finance world calls asset classes. Let's break them down. First, you've got cash and savings. Feels safe, but mathematically, it's a losing game against inflation. Then there's fixed income, things like government bonds. They've offered some pretty great returns recently, around 18 to 20%, but they lock your money away, very low liquidity. Equities, or the stock market, absolutely beat inflation long-term, but they require serious patience and, honestly, deep research. And then we have our cultural favorites, right? Gold, which is safe and tangible, but generates absolutely zero income while it sits in a vault. And real estate. Fantastic for building wealth for sure, but it requires massive initial capital and has terrible liquidity. I mean, you can't exactly sell a tenth of a plot tomorrow morning if you have a medical emergency. So right about now, you might be thinking, okay, how do I avoid all these traps? Well, what if there was a way to access the amazing benefits of these assets, professionally managed, fully regulated, and perfectly diversified without needing millions of rupees or, staring at stock market charts at 2 a.m.? Enter mutual funds. A mutual fund is basically a regulated investment vehicle where money is pooled from a bunch of investors to buy a professionally managed, diversified portfolio of assets. If you are a beginner looking to beat inflation, this is your ultimate sweet spot. It solves the massive capital problem of real estate and the intense research problem of the stock market, all in one neat little package. Let me break down exactly how this magic works with a really simple analogy. Imagine 1,000 people walking around Lahore, and each person has just 1,000 rupees. On your own, your 1,000 rupees, well, it cannot buy a commercial plaza, it can't buy a diverse stock portfolio, it definitely can't buy government bonds. But if you pull all that money together, suddenly you have a very powerful 1 million rupees. Now that collective pool is large enough to buy a mix of high-value premium assets. And the absolute best part, a professional fund manager is hired to make all those smart, calculated decisions for you. And that brings us directly to the absolute golden rule of finance: diversification. You've definitely heard the phrase, never put all your eggs in one basket. Well, instead of buying just one company's stock and crossing your fingers, the fund manager spreads your pooled money across banking, energy, consumer goods, the whole shebang. If one sector takes a dip, another one rises, which vastly reduces your overall risk. Think of it like this. It's like trusting a professional, state-of-the-art car assembly line to build your vehicle rather than trying to build an engine from scratch in your own garage when you have zero mechanical experience. And honestly, the best part is just how accessible this whole thing has become. You do not need a fortune to get started. This is incredibly reassuring for students, fresh graduates, and young professionals. Many asset management companies in Pakistan allow you to begin your journey with just a few thousand rupees. One of the most established names in this space, and actually the sponsor of our source material today, is MCB Funds. They've completely digitized the process with their app called iSave. You can manage your entire portfolio, track your gains in real time, and seamlessly withdraw your money whenever you need it, completely free of hidden charges. Okay, let's do some rapid-fire myth-busting because there is a lot of misinformation out there that just keeps people paralyzed. Myth number 1. Investing in mutual funds isn't halal. The absolute fact here is that there are fully Shariah-compliant mutual funds available. These specific funds are strictly supervised by boards of respected Islamic scholars to ensure that your investments are entirely free from any interest-based income. So if religious compliance is a concern for you, don't worry, the financial industry has actively solved this. Moving on to the second massive myth. I'll lose all my money if the bank shuts down. This is a huge fear for many beginners. But here's the reality. Mutual funds in Pakistan are strictly regulated by the Securities and Exchange Commission of Pakistan, the SECP. Your hard-earned money is not just sitting on the bank's balance sheet. It is held securely by a completely independent trustee. So even if the asset management company or the associated bank were to completely close its doors tomorrow, which is highly unlikely, your investment remains separate, intact, and totally secure. Which brings us to the third myth. My money will get stuck and I won't have it for an emergency. The actual reality is, open-ended mutual funds are highly liquid. Unlike that plot of land we talked about earlier or a strictly locked fixed deposit, apps like iSave literally allow you to opt for instant redemption. You can just tap a button and get your money back into your main account almost immediately. It really provides the perfect balance of growth potential and emergency accessibility. Finally, we've got to dismantle the last major myth. It's just too complicated for me to figure out. Look, we are in the year 2026. The days of mountains of paperwork and physically driving to bank branches, they're over. The fact is, the entire process is digital now. You can open an account, verify your identity, track your daily performance, and make transactions entirely from the smartphone in your pocket while you sip your morning tea. Honestly, it's as simple as ordering food online. So the crucial point now is figuring out exactly where to put your money once you're ready. There are 3 main categories, and you really must pick based on your own life situation, not just whatever your friend is doing. Money market funds are low risk, focusing on government securities. These are perfect if you just want to preserve your capital. Income more balanced funds sit right in the middle, offering moderate growth and steady income. And equity funds are higher risk, diving into the pure stock market. These are definitely best for long-term wealth. Look, if you need cash for a wedding in 6 months, stick to low risk. But if you are a 23-year-old planning for the next 2 decades, time is your absolute superpower, and you can definitely afford to aim for that long-term equity growth. And speaking of time being a superpower, we have officially arrived at the climax of this explainer, the 8th wonder of the world, compound interest. This is the ultimate financial superpower, guys. It is the secret sauce that transforms everyday middle-class savers into truly wealthy individuals over time. Compounding is, very simply put, the process of your returns earning their own returns. Let's look at the math to actually prove it. A seemingly normal number like 12% can create literal magic. If you commit to investing just 10,000 rupees every single month, treating it like a non-negotiable bill you pay to your future self, at an average annual return of 12% over 20 years, compounding will take that steady, boring discipline and turn it into literal millions of rupees. It requires no lucky lottery tickets, no hidden tricks, just time and mathematical consistency. To really visualize this process, think of it like this. It's like planting a tree, taking the seeds from its fruit and planting an entire orchard. That is exactly what your money is doing when it compounds. The earlier you start planting, the bigger your financial orchard grows. Financial literacy isn't about perfectly predicting the stock market or, becoming some Wall Street genius. It's simply about realizing that you cannot survive an inflationary economy by hoarding cash. Your very first investment doesn't have to be a perfect masterpiece. It just needs to actually happen. Which brings us to our final parting thought. Every single day, you wake up, you commute, and you go to work to make money for someone else. Isn't it finally time you set up a system where your money wakes up and goes to work for you? The question you should be asking yourself isn't, should I invest? No. The real urgent question you need to ask yourself today is, how much longer can I afford not to? Thank you so much for joining me on this explainer. I really hope this structured journey has empowered you to take that very first step toward beating inflation. Until next time, stay focused and keep making your money work for you.